Now we're going to move on to deferred revenues and deferred expenses. Remember, a deferred revenue is a transaction for which the company has received cash but not earned the revenue. It's unearned revenue. Unearned revenue is a liability. So any journal entry for a deferred revenue will include an increase in the liability account unearned revenue. Any increase in the liability is always going to be a credit. And we should receive cash, so there will be a debit to cash. That's when the deferred revenue is actually booked. So we're going to go back to Porter Properties, Cornerstone 3.5. And if you recall, they rented office space to Tiger Travel Agency on November 1st, 2011 for $5,000 a month. Now what has happened is Porter has told Tiger that if Tiger pays the entire 3-month rental in advance, they'll reduce the monthly rental down to $4,500 a month. Tiger agreed, which means they paid Porter $13,500 on November 1st, and that covered 3 months of rental. Okay, on the date of November 1st, the moment all that cash was received, had Porter Properties earned any of that revenue? No, they had not. So, on November 1st, they recorded the debit to cash of the $13,500, and then they had a liability of $13,500, which they called unearned rent revenue. That records the receipt of the cash on November 1st. However, the actual adjusting entry occurs on December 31st, and that adjustment causes Porter to actually show how much of the revenue they have currently earned as of December 31st. So of the $13,500 on December 31st, how much of that was now earned? Well, it'd be 2 months of rent, right? It'd be the November rent and the December rent. At $4,500 a month, that'd be $9,000 of rent revenue that had actually been earned. Now that's a revenue account, so we got to increase it by putting in a debit entry. That means they also now need to reduce the liability. Remember, they had a $13,500 liability under unearned rent revenue. Now they need to reduce that amount by $9,000. So they will debit that account as of December 31st. Now here's the deal with deferred revenues. If we didn't make that adjusting entry on December 31st, we would have overstated the liabilities. We would have said that Porter Properties had $13,500 of liability, what we were calling unearned rent revenue, still on its books, but it's not. They had earned $9,000 of it. We would also be understating revenue. And every time you understate revenue, you understate income, which causes you to understate stockholders' equity. We have to make these adjusting entries. Once there is an unearned revenue on the books, at the end of every calendar year or fiscal year, however the company decides to end its time periods, in order to be consistent with revenue recognition, we have got to make adjusting entries. It goes the same now for deferred expenses. What were deferred expenses? Those are prepayments the company made for goods and services that they acquire before they actually use. These are the prepayments. Now, so when we journalize, we will always end up having a debit amount to some sort of prepaid expense account. A prepaid expense account, if you recall from Chapter 2, is an asset account. And so when we increase that, we've got a debit. And then since we have paid for them with cash, we're going to have a credit to cash, which is an asset account. So looking at Cornerstone 3.6 in your book, we're going to go back to Porter Properties, and we have a situation where they had $4,581 of office supplies on hand at the beginning of November. Then in the middle of November, on November 10th, they purchased some more for $12,365. They added this amount to the supplies account so that by the end of the year, there was at least potential supplies to be used of 16,946, which we get by adding the amount they started with plus the amount they purchased. However, we get to the end of the year and we discover that there was only $3,263 of supplies remaining. Let's first deal with November 10th. What happened on November 10th? They bought some more supplies. Had they used the supplies yet? Nope. So we stuck it into kind of a prepaid expense account, or what we just call, we don't call it prepaid supplies, we usually just call it supplies. And we say, hey, there's a supplies account. Once again, we get to correct the PowerPoint. On November 10th, they had added $12,365 to the supplies account, and they paid for it with cash, but there's not an expense yet. So there's a credit to cash of $12,365, and this records the purchase of supplies. However, we get to the end of the year, and we know that there's only $3,263 worth of supplies left. Well, they had 16,946 total, and there's only $3,263 left. That means they have spent or expensed $13,683. That's, we get that from 16,946 minus 3,263. And it is an expense, which causes a decrease in retained earnings, a decrease in stockholders' equity. Every time we decrease one of those accounts, we've got to debit it. Plus, that means in that prepaid supplies account, we've reduced the total value of it by the amount we've actually expensed. So if I'm going to reduce an asset account, I've got to credit it by the same amount. This is as of December 31st. So this is the adjustment I make at the end of the year. The adjusting entry always occurs at the end of a period. In this case, it's December 31st because Porter Properties has a calendar year end. If I did not make the adjusting entries for deferred expenses, we would find that we overstate the assets and we overstate stockholders' equity because we overstated net income. We would also be understating expenses. When you understate expenses, you overstate net income, which causes the overstating in stockholders' equity. And we do this, once again, to be consistent with the matching principle. Now, there's one other very important adjusting entry that does need to be discussed before we move on in the chapter, and that is depreciation. If you recall, when a company buys long-term assets, what we call property, plant, and equipment, it has a long-term, meaning more than 1 year value to it. The property, the plant, the equipment, it will last for more than 1 year. However, every time you use it, you decrease its value, right? You know this just from buying a new car. Every time you drive a new car off the lot, you know that it is now less valuable and you can't sell it for the same amount you just purchased it. So every time we use our property, plant, and equipment, we are reducing the value. And in accrual accounting world, we have to account for that loss of value. Property, plant, and equipment helps you produce revenue. But in order to match it, we have to allocate the cost of using it as an expense. And we call this expense depreciation. Every time you use a vehicle for the course of your business, you have got to deal with the fact that you are decreasing the value of that vehicle. So we have to do something at the end of every calendar period or fiscal period, and we call it the depreciation adjustment. We have to reduce the long-term asset with an expense. Now we reduce it with the expense. Remember, an expense is always going to be a debit entry. And then we have something on the balance sheet called accumulated depreciation. And that accumulated depreciation is what we call a contra account, a contra asset account in this case. Remember, assets have a normal debit balance, but a contra asset account has a normal credit balance. Accumulated depreciation is an account sitting in the long-term asset section of our balance sheet so that we can show the loss of value over time of our long-term assets. So let's look at one last example. If you look at page 123 in your book, or back at Porter Properties, they purchased an office building in 2009 and the value of the building was $450,000. The loss of value, or what we call the depreciation expense on this building, is $15,000 every year. On December 31st, we need to record that $15,000 depreciation expense. Now we've got an expense, right, of $15,000. That means we're going to have to decrease retained earnings by $15,000. And we've got the contra asset account called accumulated depreciation, so I've got to reduce my total asset value. The total value of that building on the balance sheet has got to decrease also. This is what the entry looks like, as well as the effect on assets, liabilities, and stockholders' equity. On December 31st, we record a depreciation expense, which is a debit entry of $15,000, and a credit to accumulated depreciation of the exact same amount. So let's just sum up. Accrued revenue adjustments will cause an increase to assets, stockholders' equity, and its stockholders' equity because of the increase in revenue. Now, an accrued expense adjustment causes an increase to liability, but a decrease to stockholders' equity because of an increase in expenses. Deferred revenues, when we adjust them, will cause a decrease to a liability account and an increase to stockholders' equity because of the increase in revenue. And finally, a deferred expense will cause a decrease to an asset account and a decrease to stockholders' equity because of the increase to expense. All adjustment entries affect at least one income statement account and one balance sheet account. And for the year-end adjustments, cash is never one of the accounts in an adjustment entry. In our next video, we will work through the comprehensive example for the company called High Tech in Chapter 3.